Hello and welcome to another episode of Classroom. No more stock markets. Today we're switching gears and talking about an asset class of a different kind, real estate. There's almost a native intelligence amongst most of us about the fact that it needs to be owned and bought and perhaps prospered with, much like gold, but perhaps some of the basic stepping stones are not very well understood. To do that, my two guests today, Ramesh Chagani of India REIT Fund Advisors and Pranay Vakil of Knight Frank, both join in. Gentlemen, good to have you on the show. Straight off then, with what real estate would be defined as first, Pranay? How would you go about defining real estate as an asset?
Well, it's an asset which is very different from any other asset because of the kind of investment that it requires, the kind of exit that it calls for, and the long-term nature of investment that it is. I mean, it's not like something you get in and get out very fast, but it's something which you have to hold on to for at least about 3 to 5 years at the minimum.
Would you go with that definition, Ramesh, or would you want to flesh it out?
Yeah, I agree with Pranay. It's a long-term asset class. Your whole strategy has to be long-term, but if you stay put, you see huge returns. And like you rightly said, you require native intelligence. You do not need to be an analyst. You do not need to be a professional. You do not need to be a chartered accountant. All you need to have a deep desire to make money, and in the process, and this is the best way to go about. You can start off as a broker, and then you can land up as investor and finally a developer, and that's what you've seen most of the developers in the country have started off with. So it's an investment class where you can make big money if you're in it, if you have the native wisdom of what to buy, when to buy, and when to exit.
Before we get to the internals of this asset itself, Ramesh, while people understand and appreciate the importance of owning property per se, some concepts, for example, a REIT fund, are not that well understood. How would you go about defining that leg of real estate and owning it?
Real estate, though I said it's you need a native wisdom to go about, but at the same time you need to be aligned to investment. So if you want a professional fund manager to manage your investment, is best you invest in structures like funds and REITs. Though REITs have not opened up in India, it's a fund. In a fund, a professional manager like myself accumulates money from institutions and HNIs, and we invest it across different asset classes. It could be commercial, residential, hospitality, retail.
Pranay, the premise of owning every asset is always based on valuations. How does one go about valuing a property, a piece of property, where it's located, etc.? What would you rank out as the couple of thumb rules to apply while working with the concept of valuation?
There are two ways of looking at it. One is that you do a straightforward valuation, the way it is normally understood, by which you compare it with a similar property in the same area and get that valuation done. The other thing, what I would like to call evaluation, is what the asset is capable of doing. If you take agricultural land, for example, which is capable of being converted into, say, a NA plot on which you can build up an office, and that office could be an IT office, for example, then all of that has to be built into the evaluation.
Ramesh, there's a couple of other concepts one talks about during valuation, investment value, liquidation value, insurable value of that property. How important are these concepts while picking a property?
The most primary factor while getting into a property is your comparable valuation. I presume I'm sitting in a program which talks about classrooms, and most of the investors would be interested in investing in end user and not be looking at large properties and developing it. So I would address to people who are looking at investing into built-up properties or under construction properties. So for that, the basic evaluation model or valuation model is comparable models, and at the same time you need to take into account how many years it would take into construction, and you add your interest factor to it and you will arrive to a valuation. Insurable valuation, I don't think that's a terminology or that's a tool which is used in India yet, and The basic way about is to use a comparable valuation and the kind of developer you're going to invest with, the location and the other hidden cost which you need to take into account before investing. That's more important while looking at an investment.
Pranay, this one is the tricky one, price versus value. I mean, we've heard so often these comments made about areas in South Mumbai or South Delhi in terms of the fact that the price is just way above what the value of that property should be. How do you make that balancing act?
I think it's a difficult one, and it would depend from property to property, and it will also depend from individual to individual. Because if it is the first purchase which you are doing to buy a house for yourself, obviously you have to look at what kind of value you're going to get out of it. You look at everything. You look at the way the breeze is blowing. You look at the feng shui. You look at every possible aspect because you're going to move into that particular house. So the value of that, it's going to be very, very different from an investor who's just kind of buying it blind almost. Idea is to make money. Also, let's look at a situation where you're booking something under construction. As an investor, you're a little bit indifferent as to how it comes up, as long as it comes up the way it was promised. But if you are an actual user, your view is very, very different. I mean, you will visit that place something like 20 times during under construction. You'll possibly walk up to the floor which you have booked and all of that. Now, that is where the value comes out from. That is where the importance of buying that asset, which is so close to your heart, is kind of embedded.
Okay, gentlemen, time for a break. When we come back, more on this whole concept of owning real estate, or indeed owning it via a fund if you want to, and we'll try and pit real estate against other asset classes to figure out whether or not this is the best bet to put your money on. We'll come back and do that.